Hey, everybody, Tim Albrecht here, and thank you for listening to the YFP podcast, where each week we strive to inspire and encourage you on your path towards achieving financial freedom. This week, I had a chance to welcome back onto the show Tony Umholtz, a mortgage manager for First Horizon, formerly Iberia Bank. During the show, Tony takes the hot seat as I ask him questions posed from the YFP Facebook group related to financing a home purchase. Questions we cover include how much down payment is required with a doctor-type loan, what to look for when choosing a lender, and ways to reduce the interest rate on a loan. Before we hear from today's sponsor and then jump into the show, I recognize that many listeners may not be aware of what the team at YFP Planning does in working one-on-one with more than 250 households in 40 plus states. YFP Planning offers fee-only, high-touch financial planning that is customized to the pharmacy professional. If you're interested in learning more about how working one-on-one with a certified financial planner may help you achieve your financial goals, you can book a free discovery call at yfpplanning.com. Whether or not YFP Planning's financial planning services are a good fit for you, know that we appreciate your support of this podcast and our mission to help pharmacists achieve financial freedom. Tony, welcome to the show.
Tim, it's good to see you. Happy to be here.
Excited to have you back, and always appreciate your expertise and what you have to share with our community. And this is an exciting episode as we're doing a commonly asked questions about financing of a home purchase. And we've got a handful of questions that have come in from the YFP Facebook group. And we've got some others that either you or I often get asked as well. So we'll sprinkle those in throughout the episode. I suspect most of our listeners now know who you are. You've been on the podcast several times, but don't want to assume that. So give our listeners some quick background on who is Tony and the work that you do with First Horizon.
Well, thanks, Tim. Yeah, I've been scary to say it now, but I've been in the mortgage business 20 years, and I've been with First Horizon now. It's been almost 5 years, and I'm a residential mortgage lender. So I run a team. We're able to lend nationally, and we focus on residential mortgage loans, and specifically helping folks in the medical community and pharmacists. So it's been a big fun business, helping people get to the point of home ownership. So it's just been, the relationships we've built over the years have been very gratifying. So that's what we do. A little bit about us.
Yeah, it's been exciting to see the fruit of this collaboration. I actually just had someone I haven't even shared with you. I had someone reach out to me this week, and a colleague of theirs at the medical center had worked with First Horizon on a loan as a part of a move and a job transition. And she had some questions for me about what they were doing personally. And so really cool to hear other pharmacists and colleagues talking and helping one another out as they're trying to navigate this decision. So we'll talk here in a little bit specifically about the pharmacist home loan product that First Horizon offers. But let's get started. We're going to put you in the hot seat with questions that have come in from the YFP Facebook group about lending and securing a loan as a part of the home buying process. So first question comes from Randy, Tony, which is what incentives, if any, are available to first-time home buyers? And I thought this was a cool question. I bought my first home back in 2009. And at the time, you can correct me on exactly what the dollars were and the program, but there was something like an $8,000 first-time home buyer credit. I know that has changed. So what incentives, if any, are around for first-time home buyers?
Well, there's several different options for first-time home buyers, but I'll kind of get into high level, then we can get into some more of the detail options that are out there. So, for example, some of our programs will allow first-time home buyers to put down as little as 3% down. And if you've owned a home before, you cannot do that. So you have to have been a first-time home buyer. So it's limited down payment options. There's also for non-pharmacists, for people who aren't in that field, there's some limited PMI loans too, if you're a first-time home buyer, that you cannot get if you've owned before. Now, there are certain programs that are available for folks that earn under the median income for the county. Now, this can change for lots of different parts of the country. So it's very different in different states, different municipalities, different counties, but there's grant programs that are out there. And where you can actually get money towards the purchase of your home. The one thing that you have to look out for with this product is those programs is normally you have to earn under the median income for the county. So that's a challenging thing sometimes to qualify for. So it actually can be harder to qualify for that grant than it is to qualify for the mortgage. And the other thing to look out for too is a lot of times these grant programs are set up as like a forgivable loan if you live 5 years or more. But those are certainly out there, and I encourage people to look for them if they think they qualify. But it can be a little tough to qualify for them based upon that income qualification.
So many pharmacists probably won't meet that median household income requirement. Certainly worth
Right.
looking for, but I think that's a good segue to the other options that you're referring to of potentially lower percent down for first time home buyers, which is a question we have that I think Matt is alluding to, which is how much should we expect to have to put down on a primary home with a doctor loan if we can find a bank that will allow a pharmacist to qualify. So important words we need to differentiate here would be the doctor loans and those that pharmacists are eligible for, which is not all of them, even though pharmacists are doctors. They worked hard to get that degree. So talk to us about the doctor loan umbrella, and then we can talk more specifically about the pharmacist home loan product that First Horizon has.
Sure. So there is an MDDO product out there that's designated for that segment of professionals, and then of course there's the pharmacist product that we offer. And there is doctor loans that different banks have, and most banks do not include pharmacists in that MD program. They typically focus just on MDs and DOs, and we do have that product too, and we have had a lot of success with that in that community. But the pharmacist product is very similar. It has no PMI. Really, the only major difference is the loan size. It won't go as high. So currently, our loan has a cap of about $650 for the maximum loan amount versus the MD product will go higher. But it's got the same elements, similar rates, and of course, the no MI is a nice is the biggest benefit of it. But there certainly is, to answer that question, it definitely is two different types of programs out there. There's some for dentists, veterinarians, that differ a little bit from this program that we're discussing for pharmacists.
Yeah, and that was one of the reasons we were excited to begin this collaboration a few years ago, was to have an offering that reached most 48 states across the country for pharmacists. Obviously the maximum loan amount, I think for many pharmacists, is within range. Certainly folks that might be in higher cost of living areas, think about the Northeast, out West, might rub up against, some of the limitation there. But just to reiterate what you said, 3% down, first time home buyers, no PMI, maximum loan amount around 650. Other thing that's noteworthy here is minimum credit score, around 700. Is that correct, Tony?
That is, Tim. Good job.
Okay.
Yeah, 700.
So my next follow-up question here is what if someone is not a first-time home buyer? So I'm thinking of the pharmacists listening that, maybe have been in a home or two, are still looking at taking advantage of a product where they might not have to give up so much cash or use some of the equity they've already built from their previous home. Is there an option still available, even if it's not a first-time home buyer?
Definitely. Yeah, it really just the down payment just bumps up to 5% down. So you're just going up slightly with a little higher down payment to 5%. Still no MI, all the same elements of the same program, just a little bit more down.
Okay. Mm-hmm. Now, one of the common questions I get is, is there, and we're not going to talk specific rates because you and I know these change by the hour, by the day. Each time we record these, obviously we're seeing significant fluctuations of rates. But a common question I get is this product or doctor loans, at large, are they competitive with conventional rates? So, obviously I'm having an advantage here that I'm not having to put maybe a traditional 20% down, especially if I'm trying to use that cash for other financial goals. But am I potentially giving up rate on a product like this? How do you typically answer that question?
Well, you're really not, especially on the 95% product. I've found that program actually carries better rates than if I had like a non-pharmacist client that put 20% down. So you actually can feel good and confident that you're going to be getting probably a better rate than most, even folks that are putting more down than you. The 3% down products sometimes can be about the same as the 80. The 5% sometimes is a little lower rate, maybe an eighth to a quarter, depending on the day in the market. But it's very competitive. I mean, when I I've compared it to 20% down, and some days it's an eighth or a quarter better rate to do that program versus another client getting, the 20% down. So I've been very happy with that.
That's good information too, knowing the 5% down might be a little bit different than 3%. So as folks connect with you or learn more about the product, evaluating that in the moment, does it make sense to put an extra 2% down or not, and they can obviously run the math on that as well. So is this just single family homes? I'm thinking about folks that are, maybe looking at multifamily house hacking type of scenario. So are these products limited to single family homes?
No, condominiums it's available for condos, townhomes. Okay. Now, multifamily, 2-unit properties, for example,
yep,
that's going to require more down. So the LTV does change if you do a 2-unit, and the product will not do anything more than 2 units. So a triplex and a quadruplex would not be available under this program. You'd have to do a normal conventional loan, or an FHA loan if you're going to live in the home property. But 2 units would require 15% down, but you have no MI. So that's still a nice, because MI is much higher on a multifamily versus a single family.
Okay.
So it's a pretty solid opportunity if you were able to find a duplex. And then I will mention, just because I have had numerous clients who have acquired triplex and 4-unit, if you live in one of the units, it can be a great long-term investment. I do make this joke though, because I was looking at one when I was initially dating my wife, and you probably can't be married and move into a 3 or 4-plex. I'm just generalizing, but I remember when I did it when I was much younger, or looking at that time. But it can be a great investment, because if you live in 1 unit, you have 3 renters or 2 renters paying your rent, building equity. I've seen tons of success with that. It is hard to find them, because they're limited, but due to primarily zoning in most cities. But FHA is great because they expand the loan levels. You can put 3.5% down, and in some cities, I've written $700,000, 4-plex loans with 3.5% down. So it's pretty cool.
So under the pharmacist home loan product, there's an option for 2 units, but it's going to require a higher down payment. Still benefiting on the no PMI, but then if it's more than 2 units, no good under the pharmacist home loan product.
That's right. Yep.
Probably looking at FHA or other type of loan. Gotcha.
That's right.
Next question we have comes from Sarah. What should I look for when trying to find and select a lender, and red flags to avoid? So what thoughts, and obviously, I think folks know the disclaimer is that we're talking about the service of which we collaborate here, but generally speaking, as individuals are looking at a lender, what are some things that they should be looking for to make that choice?
Well, I think one of the most important is communication. I think that's critical. Are you getting your questions answered? There's different types of lenders out there, and there's a lot of good lenders out there. I think finding one that has a product that fits your needs is important. Obviously, communication to me is very important. And I'll kind of just go into a quick little summary of the different types of lenders out there. There's direct lenders that are part of a bank. That's like myself. There's correspondent lenders, and then there's mortgage brokers, who are basically middlemen between the lender and the client. Mm-hmm. And correspondent lenders, they're not typically banks, right? They're just independent lenders that will borrow money essentially to make to lend your money, and then they get rebated when they sell the mortgage, either to Fannie Mae or Freddie Mac. Mm-hmm. And service can be good across the board, but the one thing that I suggest you look out for, and I find it's really been a challenge with some of the really bigger banks and a lot of banks in general, is the service side. Because a lot of lenders are set up with what's called a centralized processing center and closing and underwriting. So those are 3 critical elements of the process. And so for example, centralized processing is like a call center in a lot of ways. And after the loan originator takes your loan application, you feel comfortable with what they have to offer, they will send it through this centralized system. Well, a lot of times that originators loan originator's defense, they can't get an answer. So they can't really communicate with you. And it just, I find that a lot of the times where I have to get involved in a transaction after it's been started with someone else, it's because of that centralized process. It's just hard because the service isn't there, the communication is not there, things usually don't happen on time. So I would just say that would be something that a lot of, especially first-time buyers, don't realize is out there, and they get disappointed in the end. And it's just because of the size, right? The scale of the operation, they centralize everything. So one of the contingencies for me to come to this company was that we had our own group, right? Our own processing group, our own closer, our own underwriting group. That way that communication and that flow would be there. We wouldn't have that communication gap or miss any of the milestones that are part of the transaction. So, again, just going back through just a summary is, the communication to me is critical, having the right product, of course, and, just making sure you have a process that is going to fit your needs, especially in the purchase market. If you're refinancing, you can wait 3 months, right? You don't want to, but you could wait 3 or 4 months and be okay. But if you're in a purchase transaction, you have to execute on time. You have to have your loan commitment on time. So you want to make sure you work with a lender that can do all of those things. So again, I'm being general here because there's a lot of good lenders. So I'm going to take that as a generalist.
Yeah. Yeah, it reminds me, Tony, of, when we talk about shopping for a long-term savings account or shopping for car insurance policy, homeowner insurance policy. It's easy to get stuck on comparing rates. That's easy information to gather.
Yes.
But you can't easily compare things like closing on time or, accessibility if I have a question, or communication, quality of communication interaction. I think that's where talking with peers, referrals of folks that have worked with somebody before is so important. And anyone who has gone through this process knows that there will be a bump in the road. That's going to happen. There's a lot of moving pieces or parts when you think about everyone involved in the process of buying or selling a home and ultimately getting to the point of having keys in hand. So bumps are going to happen. I think for first-time home buyers, I know I can remember being in the shoes, like, those feel big and they're weighty, and they certainly are, especially if you're trying to sell a home, to buy a home, and you're timing things up and all those moving parts that are involved. But when those bumps arise, having someone that you can communicate with, that you feel confident you already have some relationship with and you can get a hold of quickly is so important. So I think that'll resonate with many folks that are listening. Another question from Sierra, from the group from Sierra, that I think is a timely one is, if we're going into a recession and the housing market is still overpriced, is it better to wait? Is it better to wait to purchase? And you and I were talking a little bit before we hit record that even from 3 months ago when we recorded, we're seeing some changes that are happening in the market in terms of, the competition that's out there and the bidding wars. And certainly we've seen a change in interest rates as well recently. So what are your thoughts here on Sierra's question about, the timing of purchasing a home, especially given the current economic conditions?
Well, that's a great question, and a lot can go into that question. There's a lot of information that we could talk about here. The main thing I would say is everyone's situation is different. We're all in different situations. So if you're in the middle of renting right now, and because rents are going up at a nice clip each year, and they're forecasted to continue to go up over the next couple of years. So if you put that against homeownership, a lot of times it's going to be way ahead to rent, or to buy versus rent. What I'm seeing right now in the market is a very healthy, normal market. What we saw the last 2 years, the last year and a half, wasn't normal. I mean, we had a spike in demand, not enough inventory, and we had. I mean, I have a lot of clients that couldn't get a property, and some of them bowed out of the market, and a lot of them actually are coming back in now because the market's, it's easier to get a home under contract, and you can get better terms. Instead of having an appraisal gap contingency, can't get an inspection, all these other things that were going on. Now you can get a normal inspection done. You can have an appraisal contingency, maybe even some negotiating power on that appraisal. If something's coming back on the inspection, you have some negotiating power to get the price lowered. I've seen that happen a few times lately.
Normal stuff. Normal stuff.
Normal stuff, right? Normal stuff, right? Great stuff. And then, as far as the housing market, recession, and there is a chance, guys, there's no doubt there's a chance we could have a recession. But one thing I've learned is no recession looks alike.
Mm-hmm.
So we can't go back and say the recession of 2020 obviously it's unique. The 2008 recession was unique. Yeah. I started in the business in the .com one that we had, and that was unique, right? All of these have their own elements. Like the .com crash that we had, the stock market got penalized, but stocks or real estate actually did very well. So nothing's going to be, history does not always repeat perfectly. Everything's unique in a lot of ways. We learn from history, but that doesn't necessarily mean that it's going to repeat that way. So I would say you always want to be aware of what's going on. And one housing metric I've used over the years is the Case-Shiller Index. Okay, that's been one of the best housing metrics that I've used over the years. And it's still forecasted to have positive returns, I think, over the next couple of years from when last time I looked. So that's a good forecasting tool. The other thing I'll say is everyone's market is different. Okay, everyone's market's different. We can't generalize and say, well, real estate's just not going to be good, because every pocket of the country is going to be a little different. So there's actually been, even in the last couple of years, been a few pockets that have went down a little bit. So not a lot, but there's been a few pockets. So just keep that in mind, that real estate can be very much a geographic situation. I do, to say it's overpriced is tricky. I had lunch last week with a builder that I've known for some time, and this kind of hit home with me when he told me what it cost for them to get trusses, materials, labor to build a home. It's hard for me to see prices really. I mean, if we look at that metric, it's hard to say prices are going to really drop, because I don't see those the underlying commodities are not going to fall that much, and labor's still there. So I mean, it's still going the other way. So I think it's a good question. It's just hard to say that if we go into a recession, that's going to equal a guaranteed lower housing prices, because it may not be the case, and I always say, if you're going to be in a home for at least, if you project yourself living in a home or an area for 5 years, it's going to make sense to own. It's hard not to. I mean, if you look back at history, you're usually going to come out way ahead versus renting.
Especially with, your comment before about where rent rates are at today, that's changed even in the last 3-4 years. Certainly the pandemic has escalated that as well. And, that is really where, we talk about, is your home an asset? We talked about this on the podcast before. Like, when you see people that have been in their home 20, 30, 40 years, and you see the appreciation, and also not just the equity that's been built, but also the costs that come through transactions. So if you're moving every 3 to 4 years,
great point.
Transaction costs, closing costs, moving costs, refurnishing the house costs that come with all that as well. So, I think that longer term view, if possible, and that's not always possible, right? Jobs, family, certain things take us to different areas. But, if we can find that home and be in that home for the long run, that's where we really start to see, I think, the home become an asset and a part of our financial plan.
No question. Having that equity, just the monthly payments going towards some equity every month. Yep. It adds up over time. The tax benefits. I mean, if you're comparing it versus renting, it's hard to not own, even if it's a flat market. Even if the market's zero, right, over 5 years, you're still going to typically come out well ahead, because rents are going to go up. The one thing too you have to watch is these commodity costs. We're still underbuilt as a nation. We didn't build enough inventory the last 12 years to support our population growth and our incoming population by immigration to the country. So as long as that continues, we're going to be in this situation of rising rents and rising prices. It's inventory levels you have to watch. If suddenly you see in your area you've got over 6 months to 10 months of inventory, then prices will probably come down some. So I think that's the metric you watch too, is inventory levels. And local realtors can provide color on that.
Which is another great reminder of how local the markets can be and how inventory is going to fluctuate from one market to another.
That's right.
Sierra also asked, what are some ways to get lower rates? And I suspect the question here is outside of, just making sure that the individual product and offering is competitive. I suspect this is referring to perhaps purchasing points and trying to lower rate that way, which might be top of mind for folks right now, considering where rates are relative to just a couple of years ago. So what thoughts do you have in that area, Tony?
Yeah, it's great. It's a great question. So a couple of things. I think one thing I would say is you always want to make sure your credit score is the best it can be. That'll always help you with the best rates. Typically 740 and above is going to be the best, premium best rates available. And then there's little segments under that. I have, different times, we look at the market quite a bit, right? I follow the market. I will admit I'm a bit of a nerd when it comes to that stuff. So I do follow the mortgage market pretty closely in the rates. And this has been a time since probably, March, even earlier, maybe February. I have not been an advocate of buying points this year because I felt like they spiked so quickly, we'd see lower rates. And we have since the peak a few months ago, rates are down about 50 basis points, which is half a point from the peak. So my gut is over time, we'll see rates come back to the mean a little bit. But points are always a way to buy a rate down. Okay. So you can pay points for that. Again, you got to make sure you have the payback period in place, because if you pay 1 point, you may only get a quarter or 3/8. Usually it's a quarter off the rate on a 30-year fix. So it's going to take you 4 years of payments to just break even.
Yep.
And at that point, you'd be in the money. So I'm only an advocate of it in certain times and when people are in a position where, hey, I'm going to be here forever. I'm going to keep this asset for a long time.
Yeah.
Then we'll do it. But and especially when we see these rates go up quickly and the yield curve inverts, which is what we have right now, when basically the 2-year Treasury note is higher than the 10-year Treasury note, typically that is going to lead to lower rates in the future. So I'm not a huge, fan of my client paying a lot of points for that to buy rates where I think they could refi in the future. So, but I think the other thing I'll mention to answer Sierra's question is how to get lower rates. And this takes a little bit more courage. And I'm more of a person that likes to lock loans unless it's a pretty clear market that rates could go down. And then the other thing, it's the client's decision. It's not my decision. It's not my staff's decision. But there are times where, like, I have a few clients who are financial people and they follow the markets and they'll say, Tony, I want to float the market. And when you see this, do this. So there's a couple people like that I'll have every year that will float the market and a lot of times can get better rates that way. So that's it takes a little bit more courage and depends on the cycle that we're in. But if we do go into a recessionary cycle, floating the rates may be a pretty good way to get a lower rate.
Yeah.
So that's another way to do it.
Yeah. And I think that gets the risk tolerance, comfort level,
right.
Margin in the budget or not, right? I think especially for first-time home buyers, that may or may not be something that folks will be comfortable with.
Agreed, Tim. Sleeping at night is more important.
That's right. but for people that want to nerd out on that and feel comfortable with that risk, that's right. An option.
That's right. Yeah.
2 last questions I have for you. One about the pre-approval, one about student loans. So let's start with the pre-approval. How long does a pre-approval last? And I know this question's coming up a lot because of maybe people are going into this process and then they decide, hey, I'm going to bow out, and then they decide to get back in. So talk to us about how long that pre-approval period will last.
So when we do a pre-approval, and this is pretty much general for all lenders, when we do a pre-approval letter, we run a credit report. And typically that credit report is good for about 90 days is when that credit report is good through. Then after that 90-day period, typically we'll have to do another credit pull. I don't always do that. I mean, if I feel like the client hasn't had any credit, like we've had that conversation, don't buy anything new. Have you bought any, I haven't bought anything, no new cars, no credit cards, things or new credit cards. As long as that's the case, we usually will keep it pretty active. But if they need an actual letter updated, we'll typically run credit again. So it's 90 days is to answer the question. So I would say every 90 days, if you're going to go out beyond that, you probably need another credit update.
And a good reminder, if folks haven't heard you say that before, just to sit tight. We don't want to have major financial changes or decisions that are happening in that 90-day window.
Right.
So, yeah.
That's right. Yeah. And I try to keep, we try to keep any of those big transactions to a minimum, when you're looking.
Last question is student loans. This keeps coming up a lot because we're now 2+ years into the federal administrative forbearance, set to expire end of this month. So we're recording mid-August. We're expecting an announcement literally any moment now from the Biden administration. But nonetheless, we've had more than 2 years since March 2020 where folks have not had to make a payment on qualifying federal loans. And so the question that comes up here is, how are my student loans factored into the debt component, the debt to income ratio, especially since I haven't been making payments and there isn't necessarily a track record of what repayment plan I'm in?
Right. No, it's a great question. So there's two ways to do it. We might have a lot of clarity in the next few weeks, so you may know. But so in the case of absolutely no payments being made, there's a factor we use on the total amount of student loan debt. It's not as high as like Fannie Mae or FHA would, basically conventional loans and FHA loans require. It's a lower factor. It's about half of that, but we basically take a factor of your payments. So like if you had let's just say you had a $10,000 student loan, we would factor about $500 a month for that student loan.
Okay.
That makes sense. So $1,000 is what Fannie and FHA would do.
Yeah, one of the tricky things I know that our borrowers are.
I'm sorry, I've said that wrong, Tim. Let me rephrase. It would be $50 per 10,000.
Yep.
So
I'm following you.
So yeah, so $100,000 would be $500 a month. So I said that wrong.
I think I'm doing the automatic conversion in my mind because we have so many people that's 100, 150, 200, 250,000. So yeah, and that's one of the challenging things, because some folks might be on a forgiveness pathway where they're paying a very small monthly payment, but they haven't necessarily started making those income-driven repayments. So again, another example where I think working with a lender who, number one, you can communicate with, number two, who has some experience working through these issues and answering these questions that I suspect many of our listeners have, would be really helpful. So Tony, this has been great. Love to see the engagement from the community on this topic. I know home buying continues to be a topic of interest among our listeners. So really appreciate you taking time and sharing your expertise.
Thanks for having me, Tim. It's great to be here.
As we conclude this week's podcast, an important reminder that the content on this show is provided to you for informational purposes only and is not intended to provide and should not be relied on for investment or any other advice. Information in the podcast and corresponding material should not be construed as a solicitation or offer to buy or sell any investment or related financial products. We urge listeners to consult with a financial advisor with respect to any investment. Furthermore, the information contained in our archived newsletters, blog posts, and podcasts is not updated and may not be accurate at the time you listen to it on the podcast. Opinions and analyses expressed herein are solely those of your financial pharmacist unless otherwise noted, and constitute judgments as of the dates published. Such information may contain forward-looking statements which are not intended to be guarantees of future events. Actual results could differ materially from those anticipated in the forward-looking statements. For more information, please visit yourfinancialpharmacist.com/disclaimer. Thank you again for your support of the Your Financial Pharmacist podcast. Have a great rest of your week.